Close the trading app for 10 seconds. The number you see on your screen, 108, 110, 112, might be a price, new for paper, but the real-world price, the one paid for metal that can be picked up today, has already printed a different number. In the UAE and across major Middle Eastern bullion hubs, buyers are paying the equivalent of roughly $170 per ounce for immediate physical silver. Not ship later, not maybe next week. Immediate delivery, though 0.26. And if that sounds impossible, good. That disbelief is what a decoupling feels like right before it becomes obvious to everyone. Today I'm going to show you how one commodity can have two prices at the same time. The screen price, paper contracts and rolling promises. The street price, bars you can actually receive. And why the street price is now the only one that matters. Why the charts just failed you. Charts measure trades. They do not measure scarcity. A chart can show volume. It cannot show empty shelves. So when someone says silver is $110, you should ask one follow-up question. At $110, can you actually get it? Because the physical market is now running on a triple premium. The triple premium. Why $170 exists premium. 1. The supply vacuum. Since January 1st, export licensing tightened, and a huge portion of refined silver flow has been trapped inside China's own system. Whether you call it licensing, gating, approvals, doesn't matter. Less metal is leaving the biggest pipeline, and every downstream hub starts draining. Premium 2. The paper-squeeze Western futures markets can trade endless claims because contracts can be created, rolled, and netted without metal-changing hands. That illusion works until enough holders demand delivery. When too many people want bars, the paper system doesn't discover price. It discovers limits. Premium 3. The hub drain. Dubai and the UAE are a distribution artery. Metal moves through these hubs to businesses, refiners, jewelers, and investors. So when that artery gets drained, when 1 kilo and 5 kilo bars vanish, the price you pay is no longer a commodity quote. It's a rescue quote. What we're hearing on the ground. Reports from dealers and logistics desks describe the same pattern. 1. High turnover retail counters, no immediate stock. 2. Vault-linked inventory, allocated bars are spoken for. 3. The only offers left are pay-up offers. Buyers bidding above spot to pull metal out of someone else's allocation. That's how you get a 60% premium over London NY spot. Not because people love overpaying, because they're buying time. And when a buyer is buying time, they're not negotiating $1. They're asking, can you deliver yes or no? A quick walkthrough. Try to buy it. Imagine you're a normal buyer with cash in hand and you call 3 places. Call 1, a big online dealer in the West. You hear, we have it, but it's delayed. 2 to 4 weeks. Payment clears first. Call 2, a local shop. You hear, we can order it. No guarantee on delivery date. The quote can change. Call 3, a hub desk connected to a vault network in the UAE. You hear, we can deliver today. The price is higher. Now ask yourself, which of those is actually selling silver? Only the third one is selling certainty. The first 2 are selling a future maybe. And in a tightening market, maybe becomes a product with a rapidly rising price. Why bar sizes matter? This is how shortages show up. The market is not one pool of silver. It's multiple forms, and each form has its own bottlenecks. Retail bars and coins, small units, they vanish first because everyone can afford them. 1 kilo and 5 kilo bars, the bridge between retail and wholesale, these get drained when serious money arrives. 100 O's bars, classic investor format, availability becomes allocation only. 1,000 Oz bars, industrial and vault format, harder to move but decisive when they go tight. In the Middle East story, the signal is loud because 1 kilos and 5 kilos bars are the preferred grab-and-go inventory for high-volume buyers. When those shelves go empty, it tells you the squeeze has moved beyond hobby demand. It has entered the pipeline. The $170 math, how a 60% premium prints. If the screen price is $110, then a 60% immediate delivery premium is simple. $110 because 1.60, 176 hours. So when you hear $170, that's not a fantasy number. It's what happens when the market starts pricing delivery more than the metal itself. Premiums rise because replacement cost rises. If a dealer sells you a bar today, they must replace it tomorrow at whatever price clears the market. When replacement becomes uncertain, price becomes protective. Why Shanghai is pulling the string. Now connect the dots. Shanghai is the lead domino. When a large share of global refined silver is effectively tied up inside one system, the global market doesn't magically create new bars. It reroutes. It rations by price. So Shanghai prints $140, $150. Then the premium leaks into nearby hubs. Then Dubai offers $150, then $160, then $170 for immediate delivery. This is not a regional anomaly. This is the price of metal when the buyer refuses to wait. Why Japan's physical price is screaming higher layer in a third buyer base, Japanese retail and small institutions. When your local currency feels unstable, you don't shop for returns, you shop for anchors. So local physical pricing, translated back into dollars, can surge because it's demand plus urgency. That's how you see 150 equivalent physical pricing show up while the screen price in New York still looks normal. Different markets, different constraints, same metal. The COMEX problem in one sentence. The paper market sets the headline price, but the physical market sets the survival price. You were trained to believe the headline price is real, but right now, the headline price is the last price before shortage becomes undeniable. The physical market has already moved on. The ratio that explains the illusion. Different analysts quote different numbers, but the structure is the same. Hundreds of paper ounces are traded for every ounce that is actually sitting in a deliverable vault category. Call it 300 to 1. Call it 370 to 1. The exact figure moves. The point does not. If even a small percentage of paper holders demand bars instead of cash settlement or rolling, the system hits a bottleneck. And when a system hits a bottleneck, price doesn't move smoothly. It gaps. How paper can fall while physical rises. This is the part that confuses people, so let's slow down and make it simple. Paper silver trades like a financial instrument. It can be sold in huge size instantly, especially when traders are using leverage. When a wave of selling hits the futures tape, the screen price can drop even if not a single physical bar changes hands. Physical silver trades like a supply chain. It moves through refineries, fabricators, vaults, and dealers. It has shipping, insurance, fabrication fees, and, most important, time. So even if the screen price dips for an afternoon, the physical market can stay tight because the supply chain did not magically refill. That's why you can see this strange pattern. Screen price, down $3, physical quote, unchanged or even higher. Because the physical quote is not reacting to a candle. It's reacting to an empty reorder pipeline. What capitulation looks like in a delivery market. When people say the exchange will break, don't imagine a dramatic announcement. Imagine a series of small moves that all point to the same reality. Delivery is expensive. Capitulation usually looks like higher and higher premiums for ready bars, sudden spikes in lease rates and borrowing costs, more delays explained as logistics, more offers to settle in cash instead of metal, more private deals off exchange at whatever price clears. And then one day, a simple phrase shows up everywhere, out of stock. At that moment, the headline price loses authority because nobody can use it to complete a transaction. Why $170 tends to become a floor, not a firework. Think about the buyer who paid $170. They weren't buying a chart. They were buying continuity. Once a business or a serious buyer starts paying that level for certainty, they build their next decisions around that reality. They don't suddenly go back to negotiating like it's a calm market. So the more real volume that clears at $150, $170, the more that range becomes the reference for future physical deals. That's how a regional premium turns into a global floor. First in private quotes, then in public quotes, and finally on the screen. How you can verify the reality without guessing. You don't need secret sources. You need 2 phone calls and 1 rule. Rule, only trust prices attached to delivery terms. Call a dealer and ask, is it in stock today? Yeah, what is the price if I pick it up this week? What bar size is available right now? Then call a second dealer in a different region and ask the same questions. You're not hunting for the lowest number. You're measuring the spread. If the spread is widening and availability is shrinking, the real market is not on your app. It's in the delivery terms. A safety note, because premium environments attract traps. When premiums explode, scams explode too. People get impatient and cut corners. So move like a professional. Use reputable dealers with clear policies. Demand clear weights, purity, and photos or serial documentation where applicable. Understand the difference between allocated and unallocated. Verify packaging and authenticity methods appropriate for your region. Paying a premium for certainty is one thing. Paying a premium for a fake is another. Why industrial buyers don't care about your chart, retail argues about $5 swings. Industrial buyers argue about, can the factory run? Solar, AI infrastructure, EV supply chains, electronics. For them, silver is not a trade, it's an input. So when the metal gets tight, they bypass the screen. They go directly to where metal still exists. They pay premiums, they lock supply, they take it out of circulation. That's what a real shortage looks like. Not one big headline. Thousands of quiet procurement decisions. Oxygen vs. the gauge. Imagine you're in a sealed room. There's a gauge on the wall that reads 100%, but the tank in the closet is almost empty. Would you trust the gauge or open the closet? The chart is the gauge. The vault is the closet. Right now, the closet is telling the truth. The myths that will get you hurt. Myth 1. If spot is $110, premiums must fall. Premiums fall when supply returns, not when charts look calm. Myth 2. If the chart dips, the deal is back. A dip doesn't refill vaults. It can be a distraction created by paper selling. Myth 3. They can always print more metal. Refineries can pour bars, but they cannot fix raw supply and logistics bottlenecks instantly. Myth 4. Regional premiums don't matter. They matter because regional premiums are how global shortages migrate. What to watch next? If the triple premium is real, you'll see. 1. Premium stickiness. Premiums stay high even on paper pullbacks. 2. Cross-region contagion. $140, $150 becomes common in more hubs. 3. Bar size migration. Tightness moves from 1 kilo, 5 kilo into larger forms. 4. Allocation language. Only by quote. Only for existing clients. No guarantees. 5. Higher urgency bids. Buyers offering above published premiums. These are not opinions, they're symptoms. The 2-market checklist. Use this instead of charts. If you want to track the real price of silver, stop staring at one screen and track. 1. Local dealer inventory, 1 kilos and 5 kilos availability. 2. Delivery times, in stock versus pre-order. 3. Premium trend, widening or narrowing week to week. 4. Large bar bids. What are institutions paying for 100 O's and 1,000 O's forms? 5. Paper versus physical spread, the gap between quotes and real offers. 6. Substitution talk. Are buyers accepting alternatives or refusing them? When these indicators tighten together, the chart is late. The hard truth about waiting for the dip. I get the psychology. You want confirmation, you want a clean pullback, you want to feel smart. But in a physical squeeze, dips can be optical illusions. If the shelves are empty, a dip is not a discount, it's a distraction. So if you're waiting for silver to go back to $80 while physical is clearing at $150 to $170 in major hubs, you're not being patient. You're pricing the wrong market. 3 scenarios to think through. Scenario 1, the screen catches up fast, premiums stay high, and the official price climbs toward the street price. Scenario 2, the screen chops and whipsaws, but premiums remain stubborn because supply is still tight. Scenario 3, a temporary paper smash creates a scary dip, yet physical quotes barely budge because bars are still scarce. All 3 scenarios share one truth. In a shortage, you manage decisions around deliverability, not drama. So don't ask, where's the next support line? Ask, what happens to availability if I wait 30 days? That question is the adult version of price discovery. What this means for you, no hype, just reality. Decide what game you're playing. If you're trading paper, your chart is your battlefield. If your goal is ownership of metal, the chart is not the scoreboard. The scoreboard is, can you source it? Can you receive it? Can you verify it? Can you hold it? Because the world is quietly shifting from price discovery to allocation discovery. The line that matters in shortages, the real price is the price of certainty, and certainty is expensive. That's why the Middle East can print $170 while New York still prints $110. One market is selling claims, the other market is selling bars. So I want to ask you one simple question. Are you holding the metal or are you holding a promise? Drop your answer in the comments, metal or paper. And if you want more updates focused on availability, premiums, and real-world pricing, not just candles, subscribe. If you want a reality test tonight, do this. Search for the exact product you would buy, 1 kilos bar, 5 kilo bar, 100 O's bar, and note 2 things, delivery time and premium. Then do it again in 7 days. If the delivery time stretches and the premium widens, the squeeze is tightening. No matter what the candles say, comment your region and the premium you're seeing. The community can map the real price faster than any chart feed. Now,